Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Thursday, October 1st, 2020. And our top stories today, we'll take a look at the latest innovations in managed accounts and just what will target date funds look like in the near future. Well, joining me now to discuss this and more is Randy Plovaika. He's a journalist with Fund Intelligence. Randy, thanks so much for joining us on the program this morning.
Thanks for having me, Jeff. Always good to be here.
Always great checking in with you. You have a great beat. You get to cover what asset managers and U.S. record keepers are doing. So let's check in on managed accounts. There's a big trend afoot in the industry to get people into managed accounts within their 401ks and 403b plans. What's the latest news there?
Yeah, so I think right now we're seeing a lot more partnerships and collaborations up front, more than I've seen in years previous. You're getting a lot of firms now that are either outsourcing it and bringing it in via a third party, or they're starting to build that out themselves. I've talked to quite a bit of players in this space who, when they have scale, they're willing to build it out. And some of them are willing to outsource again to third parties that already have that expertise built out and ready to go. In general, I think it's almost become table stakes now for a lot of major 401k and 403b players to have, right? It seems to me that in order to be a viable record keeper, to be a viable asset manager, you're going to want to have managed accounts. And it makes sense from a business perspective as well there too.
Yeah, I would agree with you. One of the challenges is we've talked about a lot over the years, Randy, because you cover the beat and I'm in the beat with you, is the fact that there's really little money to be made in record keeping. Where does the money be made? In asset management and services like managed accounts. And quite frankly, people are demanding and asking for more personalized levels of service. Is that kind of what the takeaway is here with based on your conversations?
Yeah, so it's more of a sense that people want personalization, they want customization, and they want really that kind of one-to-one approach. Now, it doesn't necessarily mean that every single participant gets an advisor to themselves, right? We do know they have multiple client bases, and oftentimes they have their own portfolio of people to manage. But what you're getting out of that is basically more tailored approach to retirement. Maybe somebody wants a different kind of mix of funds in their account. Maybe they want a different kind of drawdown strategy. Maybe they want to be still pretty well invested even in their retirement years. It all kind of depends, right? And I think every investor sentiment is unique, even if there are some parallels between each individual participant. And ultimately, managed accounts serves a really good way to answer that while still collecting a decent service fee from them. If you're an asset manager, if you're a record keeper, and you're offering this, right, you're keeping them on your platform, you're keeping them in-house, you're managing their assets well. So there's no complaints on their end. And at the end of the day, from a business perspective, you're able to benefit too, right? You're still going to collect maybe 20 basis points, 30 basis points worth of a fee, sometimes higher, sometimes lower, depending on what you're doing. But it really brings in the value of a lot of managers that are more actively involved. And so managers that like to be high touch, they're able to actually do that. There's really no, not to say limitations, but for them, they can be as involved as the participant wants, and vice versa. The participant can be involved as they need to be in order to feel comfortable, secure, and really less anxious about their retirement savings. As you know, obviously March, we had the market dislocation. And I think it really brought a focal point to people having anxiety around their investment savings, right? It's 2008, and now we saw 2020, two really recent periods where you've seen pretty big market dislocations. I think managed accounts offer a solution of saying, okay, well, we're going to be able to manage through volatility, but you're also going to be able to see a lot of good upsides during the good periods when, we're on the up and up of the roller coaster and maybe not so much on the down.
Randy, you bring up a really good point, and we've kind of lost focus on the Secure Act, but it really lays the groundwork for some type of annuity or income stream at retirement. And just based on what we've seen in market dislocations, that's something that I would expect that managed account providers and vis-a-vis the record keepers and these third parties that are supporting them, they're looking to solve that issue as well, because they want to make the managed account solution like a target date fund or some other balance fund, a one-stop shop.
Mm-hmm. Yeah, and I think that the conversation around annuities has shifted a bit, right? I think the terminology people are using that I'm talking to now, I don't often hear the word annuity, although they are annuity products. you're hearing people refer to them more now as guaranteed income or non-guaranteed income, depending on kind of the structure of the actual solution or product. But you're hearing it, I guess, almost rebranded in a way, which is interesting, right? From the marketing perspective, it leaves a better taste in the mouth than per se the word annuity. Oftentimes, a participant hears the word annuity, they shy away. They're like, "Oh no, please get that away from me." Depending on the participant, that's not universal, by the way. But for some people, there is that negative tinge to it. And I think, rebranding it as guaranteed income has been helpful for driving education, driving adoption, driving engagement. And I think the Secure Act obviously has been able to drive those conversations, right? Because now that it's introduced, you need to bring up all your participants, all of your advisors, all your plan sponsors up to speed on kind of the compliance aspects of it, what it means for their portfolio, what it means for their retirement mix. And so it creates an opportunity to talk about them in a way that we didn't have prior. And also just creates a way to actually bring them into the portfolio that also really did not exist prior to this.
Randy, when it comes to the consultants and advisors, those are fiduciaries typically that work with the employer who sponsors a retirement plan. Are you hearing more and more about the two words due and diligence to be able to understand how these managed account platforms work, the algorithms, the fees, understanding, kind of lifting up the hood, peeling back the onion? I'm going to use every cliche this morning, but are you hearing more that this is more of a focus of their practices?
Yeah, and I think sometimes too, they're also looking to, not to say hand that off, but I think a lot of sponsors and advisors are already looking for solutions that they know and trust, i.e. from big brands that they know already have vetted solutions that work. And I'm not going to say they're going to go to the asset managers, the record keepers of scale and just choose them. But people go with what they know, right? So they might have 3 to 4 that are top of mind. But I think nowadays we're seeing a lot more collaboration on the fiduciary side too, wherein you're getting third parties coming in, helping out vet the solution, vet the product, to make sure that it's, number one, safe to use, and then number two, you won't run into any liability risk if you're the sponsor, if you're the advisor. And I think the due diligence conversation is really interesting now, because I think obviously nobody ever wants to end up in a court or getting having a complaint filed against them or any type of legislation that or litigation such as that. But I think nowadays it's pretty well vetted. And a lot of the cases that we're seeing with managed accounts, if any, are pretty minute, if at all.
Yeah, I think you bring up a really good point, and it's something that the reason why I brought up due diligence is that I think as a fiduciary, we're seeing more. You implied this. We're seeing more legal ramifications as it relates to litigation around fees, not just fees for record keeping, but fees for some of these other services, fees for investments, et cetera. Well, it's certainly going to be interesting to watch and see how participants, employees respond. Randy, I want to go to a quick break, but when we come back, we're going to flip the coin and talk about target date funds. Randy's going to give us the download on that. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Randy Plavica of Fund Intelligence. Randy, thanks so much for staying with us this morning.
Of course, glad to be back.
So we're going to flip a coin. We're going to jump from managed accounts, Randy, to target date funds. And target date funds, as we all know, and maybe the viewers do as well, they have really seen a tremendous amount of growth since the passage of the Pension Protection Act in 2006. But there are some developments there, Randy, and perhaps in competition, perhaps with managed accounts. What can you tell us?
Yeah, and so a lot of the conversations I've been having recently with asset managers, record keepers, et cetera, and the like, are really around what the next evolution of target date fund design looks like. I think right now we're in a really interesting spot where product development can really flourish, wherein you can try new things and not to say too much risk, but you can try new things and bring them in a way that we couldn't before. You can try different glide path strategies, different asset allocations, different aspects to the target date fund. And I will drill down on a few of those. I think the most interesting one, and it kind of ties into managed accounts, is retirement income aspects of a target date fund. I've seen a lot more interest around bringing in retirement income aspects just straight onto a target date fund, pairing them with another guaranteed income type product, or just making the target date fund literally an all-in-one package. Every firm is taking, I think, a different or slightly tweaked approach to it. But I think the common thread we've seen is that there's been a bigger focus on decumulation, and not only just like talking about decumulation, but also equipping the target date fund to make it a decumulating vehicle once participants hit retirement age or hit that vintage in which they roll out into basically the distribution portion of the fund, right? I think with retirement income especially, it's kind of tricky to figure out because, again, not every asset manager is the same. Not every record keeper is the same. But what we're getting is a lot of unique collaboration that I don't think was happening quite in years prior. You're getting a lot more in-house collaboration, i.e. a record keeper that has an annuity arm that also has an asset management arm is bringing those 3 teams together to really enhance their full suite. And you're also getting what I would call like individual asset managers who maybe just have a TDF. They're starting to collaborate with people that are really experts in guaranteed income, or talking to record keepers, seeing what they need to do to make it work for their platform. And I think that, it's really nice to see that because ultimately it's going to benefit the end participant the best.
Yeah, I agree. Now, Randy, we talked about managed accounts and we talked about personalization. Does that kind of rub, target date funds, I think, are gaining 80% of assets, and that's great for especially the top 3 asset managers, but for the marketplace in general. But are you seeing some competition and as it relates to personalization? Because you really can't personalize a target date fund because that target date fund typically sits in a plan, but it also is sitting among many plans. So you don't have the ability to customize. What are your thoughts there?
I think we've seen what I will call like very minute customization efforts. And I would say wide scale because not everybody needs a customized TDF for their portfolio. People that are on the younger end of investing, i.e. from 25 to 35, really they're going to be equity heavy, as we know. And I think where you get into the customization aspects is the same place where you get into the managed account conversation. So when you're about 10 years out for retirement or 10 years off your vintage, I think that's where the customization talks of TDFs really comes into play. And so with your older participant base, i.e. the ones that are nearing retirement, it brings up an interesting conversation of what do you want your target date fund to do for you, once you hit 60, 65, 70. I would say I'm mixed on the approaches personally and kind of what I've seen happen, but I think there's been a very solid effort from asset managers and target date fund providers to really customize them as much as they can. We've seen some firms try multi-glide path options, wherein they give you 3 different glide path options at the start of your investing career, at the middle of the journey, and at the end of it. Does it work? Obviously, I would have to wait many years to assess that properly as a journalist. But I think it's interesting to offer that approach, right? Because not everybody wants the aggressive allocation, especially I think right now, people that are going to invest right now, they may be hesitant. They may want a little bit more conservative allocation, even at the start of it. And I think ultimately, it kind of depends on what the markets are doing, right? When the markets are great, you're going to want an aggressive portfolio that really just multiplies your money therein and grows your nest egg. And when markets are bad, of course, you're going to want risk aversion. You're going to want downside protection. And you're going to want every lever you can possibly pull to protect your assets. Obviously, we can't just willy-nilly, reconfigure target date funds every time we have a slight change in the markets. But I think given that they're long-term vehicles, it's nice to see that people are having different approaches and not just taking one fund, giving it to the entire participant base and saying, all right, have fun with that. You're getting a bit more of a nuanced approach in which you're getting a couple different options, again, some different mixes on the glide path, maybe some tweaks to the asset allocation, and ultimately, as customized as a TDF can currently get in its form right now.
I mean, you're seeing so many different, and I agree. I mean, I think it's an opportunity for innovation. That's a good thing for participants, good thing for plan sponsors, people in retirement plans. And by the way, Randy, people don't have to be in a retirement plan to use a target date fund, right? You can buy it within an IRA. You can be on a discount brokerage and access TDFs. Let me ask you a question, Randy, and I don't pretend that you speak for all people your age, but what is the sense from your friends, people that you've known for a long time that are within your age bracket? Are they interested in targeted funds or more interested in managed accounts, or look, do they just want to go out to like a Robinhood and do it on their own?
I think it's a bit of a mix of the very last point, and I think a little bit of target date fund. I think right now the sentiment that I get when I talk to my friends about what is a 401k plan, a lot of them, it's their first time having a career or a job wherein their employer offers one. And so they're just trying to demystify, what the heck is this 401k plan? What does this mean for me? And so their first option is usually to default to the target date fund. I typically don't advise them on what year to choose or vintage to choose. I'll tell them what I've done, and I'm sure they find that very helpful. I think with my more adventurous friend group, what I'll call them, they might be on the Robinhood, having fun, doing what I would call small trades and, learning financial literacy in a way that they may have not been taught in college or high school. But I think for the most part, a solid portion of my friends, if they have an employer that offers the 401k, they're just investing into it as much as they possibly can, whether it's enough to get the match or enough to balance student loan repayments with the match. That's kind of the mix I've seen currently. If I brought up managed accounts to them, I'm sure they would have, a giant question mark over the top of their head illuminating. So I obviously avoid that for right now. But, I think when I talk to them too, when we think about long-term investing, a lot of them want different things out of their investments. So they want, socially conscious investments. They want kind of ESG. And right now, ESG adoption in target date funds is not quite where I think maybe they want it to be. But again, they don't represent, all participants everywhere. That's pretty much what I'm speaking for myself and my friend group, where, you want a bit smarter investments, a bit more ESG brought in. Maybe not a fully 100% ESG vehicle, but you want a little bit of elements in there. So you can have kind of a green branded TDF in a way that you couldn't before.
Yeah, I think, you can't speak for everybody. Just like I can't speak for everybody. We have to speak for ourselves. But I think it is interesting to see how different groups use and cohorts use the different apparatus, the different services that are available to them. Randy, we're going to have to leave it there. Thanks so much for joining us on the program. And we look forward, as always, to having you back on very soon.
Of course. Thanks, Jeff.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, so much more, check out our daily newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.